Hello from Rotterdam, and welcome to this month's episode of the Blockchain Scholars Podcast, kindly sponsored by vechain. My name is Daniel Liebau, and I'm your host. We're recording this episode in the studio of Erasmus University, and I'm so happy that after so many Zoom sessions, I can meet a guest in person. Today's guest is another heavy hitter. He's the current president of the European Finance Association. I cannot list all his accolades here because that would fill maybe the entire 20 minutes that we have today. He's a professor of finance at Vrije University of Amsterdam and a fellow at the Timbergen Institute. In 2002, he received his PhD from Erasmus University. Our guest was in visiting positions for multiple years at various US schools, including NYU, Wharton, and Stanford, and he's probably best known for his work on market microstructure. He's also an associate editor of the Journal of Financial Economics. Welcome, Professor Dr. Albert Menkveld. Albert, thank you for joining us today. Let's dive right into our little interview session. And I guess I want to start with the question, what's the title of the paper that we're going to discuss today? And then also, what's the research question that you were trying to answer when you set out to work on this piece of work?
Well, thanks for having me and for your interest in our work. It's not just me who did that work. The paper is Equilibrium Bitcoin Pricing. Mm-hmm. We all know there's Bitcoin out there. Actually, this week it reached another high, and it's got a lot of attention. And you know, we're trying to think about how should we think about Bitcoins. It's a currency. Let's think about it as a currency. It's changing its value relative to what they call a fiat currency, the US dollar. So we have returns on the Bitcoin every week, for example. And we were trying to think about, when we study it as a currency, can we explain those returns? That's what we do in the paper.
Okay, fantastic. So I take that it's a theory paper rather than an empirical paper, right?
It's mostly theory, but we have a validation of the theory by looking at actual Bitcoin data. So there's return data exist. We have, I think, about a decade of return data, so we can nicely see if whatever the theory would predict, we find back in the data.
Okay. Can you describe that theory simplistically so that a practitioner, which is our audience, can understand? Because I know I've looked at the paper, there's a lot of math, but how would you break it down?
Yeah, so we need the math in science to do it formally, but the idea, I think, can be put to words quite easily, in the sense that if we have two currencies coexisting in an economy, so we have the transactions both in the US dollar as we have in the Bitcoin, then the consumer must be indifferent between using either one. Now, we know the costs and benefits of using dollar to purchase goods or services, and then we have to think a bit harder, like if you would do it via the alternative route. So if you would, instead of using US dollars, you would use Bitcoins, and not only to buy and sell now, but also in the future. Ultimately, they must produce the same value to you. Yeah. Now, relative to fiat currencies, if you use Bitcoins, you're going to have potentially some more transaction costs because you have to open a wallet. You have to maybe pay miners along the way to validate your transactions. But there might be benefits, and those benefits could be sizable relative to fiat currency. A good example that we use in the paper is cross-border payments. Yeah. And I think a lot of the transaction in Bitcoin is in Argentina and Mexico, explained by the fact that we have Mexican workers who go to Argentina. They work there, earn their money. If they would go and put that money into an Argentinian bank, they would charge a significant amount already. And then you have the Argentinian bank transfer it cross-border to the Mexican bank, and you have another few percentages of costs. And then your family will withdraw with another. So you have all of these costs along the way. Yeah. And an alternative is if you just buy Bitcoins in Argentina, send let's say the security code to your family, who can then transfer those Bitcoins to Mexican money. Okay. And that's a way you can save on these fees, and that's a transactional benefit of using Bitcoins. Okay, interesting. In the paper, you also talk about this concept of extrinsic volatility. Can you talk a little bit about
what that is all about?
Yeah. So a main result of the theory is that the return in a week that you earn on a Bitcoin must be such that you make up for your transactional cost and you account for your transactional benefit, and that's the key.
Right.
Now, relative to equity returns, for example, the returns are never exactly equal to what the expected return is, like what you expect to get, let's say the average return. Mm-hmm. There's always a little bit more of a little bit less, and we call that volatility. Yeah. Now, in equities, volatility must be bound by the fact that you get real payments in the future out of holding those equities. These are the dividends that you get. Mm-hmm. Now, with currencies, it's you don't have such a hard benefit of holding the currency. You must believe that future generations will accept the Bitcoin for payments. And you have to believe that there's not going to be a major crackdown by governments on Bitcoins, et cetera. So there's real risks involved that get typically expressed in volatility. So volatility could be high, and as we see in the data, extremely high relative to like equities or other securities.
Okay, cool. And what are the main results then of your paper?
So what we wanted to find is that, so we have 10 years of data. Uh-huh. There are periods where it was very hard to get Bitcoin. Opening the wallet was costly. Yeah. You had to put effort to find companies that actually create the wallet. You had to pay the miners a lot. In those periods, the model predicts we should see high returns on Bitcoin vis-a-vis the dollar, because you're suffering a lot of cost. Yeah. So therefore, the returns must be high. Okay. In other periods, the transactional benefit might be high because a lot of companies accept Bitcoin for payment, and so you get a lot of transactional benefit. And in those periods, the required returns on Bitcoin should be lower. Yeah, and that's basically what the model predicts, and that's what we try to validate in the data. So scientists, they call that a Popper falsification. The theory is really only having bite if the data can prove it wrong. Correct. And so we did that test in the data, and we find that the signs on proxies are for transactional benefits and costs. When you regress Bitcoin on those transactional costs and benefits, they carry the right sign. So indeed, in periods where it's very costly to get your money in and out of Bitcoin, you get high returns in the early periods. And in 2018, I believe, when it was very costly because mining fees were high, then the returns were really high. And at times when a lot of companies accepted Bitcoin, the returns were relatively low. Okay, interesting. And do you think that this model could be used to work with other cryptocurrencies, or is it very specific to Bitcoin? No, I think that this is a model that we wrote down for the Bitcoin because it's most known. Yeah. Maybe today you have Ethereum, you have other currencies. But the principles, they apply to other currencies. The data that we had were for Bitcoin. The best data was the longest time sample or time series, and therefore we wrote the paper down focused on Bitcoin. Sure. The model applies to other currencies as well. Okay, cool. So now that we understand this a little bit better, what are some of the implications that you can think of for practitioners? Let's say I work in finance and I need to trade a Bitcoin, or I need to make a payment. What are some of the implications of your results? So one key, it's sort of a finding that came along the way. We talked about the volatility earlier. Given that volatility is potentially unbounded, you need to be mindful of investing in this currency if you would consider it an investment. There's going to be a ton of volatility. Now, other work has shown that correlation with other securities is still relatively low. So you have some diversification by adding Bitcoin to your portfolio, but don't overdo it because you're eating a lot of volatility along the way, as we've experienced and still experience. And then the other thing is keep in mind that if transactional benefits are high and costs are low, that the expected return on Bitcoin a model predicts to be low. But that's only 5% of the total variation in Bitcoin prices. 95% is volatility that you're getting if you take on Bitcoin. Okay, that's useful.
just a little outlook on what other researchers could perhaps investigate on the back of your work, right? This is, I think, the first paper that made a big stand, published in Journal of Finance. What do you think is next in terms of research agenda in this field?
I think there's various ways in which one can improve on what we did.
Okay.
It's been 5 years since we did that empirical analysis. So new data have come in.
Yeah.
There are better proxies for transactional cost and transactional benefit than we had back in the day. Mm-hmm. So you can bring in more proxies so that we get more of a granular view mm-hmm. on what components of transactional cost and benefit are particularly important for explaining Bitcoin returns. Mm-hmm. We talked about other currencies that have seen the light. So how do they come in?
Yeah.
So there's lots of ways in which one can expand on what we did.
Okay, fantastic. And I guess last but not least, I want to ask, over the last 12 months or so, we've seen the Bitcoin price increase quite a bit from the previous crash. So any thoughts on that? And is it in line with what your model suggests, or maybe you can talk about that for a moment?
Yeah, so this is wonderful. The newspaper, exactly this week, even the local newspaper in Haarlem, my city, was on the front page. It said Bitcoin is back.
Oh, wow, okay.
With record highs. So it was traveling the globe, this news.
Mm-hmm.
But our model predicts that equally well, we could have seen a year where it was on record lows. So the volatility, you always have to keep in mind when you look at these series. You know, when this gets released, the Bitcoin might have lost 10, 15, 20%, or gain another 10, 20%. So we really don't know. But what is important is that at least there's elements of a currency in the returns.
Yes.
So the transactional benefits and costs. So what would our model predict? So maybe the last year we've seen a huge increase. So maybe transactional costs have been very high and transactional benefit have been very low. So so you see an expected return that's super high.
Okay, interesting. Well, Albert, thank you so much for coming. We've already come to the end of the session. I told you it was going to end really, really fast. Very, very insightful. And thanks for your time today.
Absolutely great to be here. Thanks for your interest in our work.
Hopefully you found today's session with Albert insightful. His work is foundational for researchers and academics to further advance our understanding of cryptocurrency pricing. I invite you to check out the other episodes of our podcast on YouTube. We discuss a variety of blockchain-related subjects, always with a practitioner focus. If you can see the value, never hesitate to forward our content to friends, colleagues, and other peers. The Blockchain Scholars podcast is still young, and we are working on growing our audience. Last, I would like to thank vechain for their continued support. I hope to see you again next month for a next episode with another globally renowned blockchain scholar.